Greetings, everyone, and Happy New Year. This is our first Employment Friday of the year, and as you know, ever since the coronavirus crisis started, I have been giving weekly or monthly updates. Now, why have I done that? For a couple of reasons. During the coronavirus crisis, when it hit, it was clear to me that the headlines that people were reading, generally, both investors and the general public, were not capturing what was really going on in the economy. There were a lot of economists, famous economists, and others, strategists as well, who were looking at the economy shutting down and were basically preparing people for a depression, if you'll remember. And you can go back to those videos. In the early days, they were called Stay at Home with Cathie, and then we switched to In the Know. And as you know, back then, I was very focused on the possibility that this was a shock from which we would recover very quickly. And that turned out to be a correct call. And every week in the beginning, and then monthly, I was delving into the economic reports that were coming out and into the earnings reports and pulling out evidence that supported or refuted that point of view. And that worked. Well, today we have a very different point of view, once again, about what's going on out there. And so that's why we do these videos. And I will get into that in a moment. First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and ARK funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher. That the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there. because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. And since February, as this rotation into value from growth really accelerated, these same algorithms have had good success with this strategy. They've been focused on inflation fears, interest rates, and valuations. And they have likened what we're going through right now to the tech and telecom bubble and the bust. And so the algorithms as well are basically looking at momentum and saying, once the bubble pops, that's what they're calling this, it doesn't stop. It's 80, 90%. We think that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time. These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, TheGlobe.com, Go.com, Flues.com, DrCoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. DrCoop, for example, averaged 1.4 million monthly average users, or the equivalent thereof. And it went public in June of 99 and was out of business in December of 01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison that we're going to see, and this is the last of the really tough comparisons, Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%. And that's probably the low point of its growth rate. And we're going to accelerate, we believe, or Zoom's revenue growth is going to accelerate from there. I gave you Zoom. Its revenue, is up 6.5-fold since the beginning of the coronavirus. Teladoc, another stock, telehealth, its revenue is up fourfold. And the Teladoc's revenue is $2 billion on average per year, or this last year. Zoom's about $1 billion. So these are real companies. Their gross margins for Teladoc, they're in the 60s, high 60s. For Zoom, in the low 70s. I may be mixing some of these numbers up, but you've got the point. Very high gross margins, solid revenues, growth continuing from very tough comparisons. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected, stay competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first, quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. We believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately. So what I'd like to do in terms of focusing now on inflation, interest rates, and valuation is leave those aside for a moment while we go through monetary policy, fiscal policy, economic indicators, and market signals. And I'll loop back to those variables to give you another point of view of how the algorithms and the quantitative strategies we believe are going to be wrong once again. So let's start with monetary policy. What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. But on the off chance, and I'm sure there's a big debate going on at the Fed, there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down, but they want to err on the side of hawkishness or being too tight right now, certainly from a jawboning point of view, because they don't want inflation to continue to escalate. We see M2 growth still around that 13% range, having peaked at 27% in March of 2020. So the deceleration is there, although it's leveled out at 13%. And what we think is quite significant is this concept of velocity, which means that money growth is faster than GDP growth. That velocity going down, we think is beginning to reassert itself, which would be anti-inflationary. Again, we have to wait for more statistics to make sure we're right on that. But we do think that M2 growth is higher than GDP growth, which means velocity is continuing to go down. If velocity were starting to go up, meaning the rate at which money changes turns over in the economy, if that were starting to go up, that would be an inflationary signal. We're not seeing that. Now, on fiscal policy, that one's easy. Senator Manchin from West Virginia is basically saying he's not going to negotiate. I think he too has been citing inflation, debt, and taxes as three reasons not to spend more money. So we think the good news there is that some of the onerous tax increases that were part of that package will not go through. And so that's good news. That's good news. Now, on to economic statistics. And here again, this is the sort of analysis that we were doing at the beginning of the coronavirus, pulling out of these reports data that you are not hearing on CNBC, Bloomberg, newspapers. They're just not making the headlines. Before I do that, we'll go through employment, since this is Employment Friday. And today's employment report had something for the bulls and the bears. Headline non-farm payrolls, much lower than expected, 199,000, expectations 420,000. There was a slight increase, but not enough to make up for that difference, an increase in terms of revisions. On the other hand, there's another measure of employment in this report. It's called household employment. That measure was up 650,000 after being up 1 million in the previous month. That's very strong. So that is more consistent with the ADP report that we got earlier in the week, which suggested that the increase was closer to 650,000. So that's a healthy sign for employment. The unemployment rate dropped below 4%. So now we're getting back to the levels where we were in the early stages of the coronavirus. And one of the reasons is the labor force is growing much more slowly. It went up only 168,000 in this last month. So the unemployment rate keeps coming down. What the bears, those who are expecting higher interest rates and higher inflation, focused on is average hourly earnings, which were up 0.6%. Interestingly, as we look through the report, it is the lower end of the wage range that is seeing some dramatic increases. And we're hearing about them anecdotally as restaurants and fast food restaurants are bidding up to bring new workers in. Now, so that's employment. So some for the bears, some for the bulls. I would say more for the bears from an interest rate point of view and on the average hourly earnings. I'm sure the Fed took a close look at that. Now, what we've been trying to size up for the last few months is where is real demand? And now that all of these employees are coming back to work and we're revving up the engine even faster, the engine of the economy, we're looking at other statistics that show a divergence from that. One of them, the most important, is consumer sentiment. University of Michigan has the best consumer sentiment survey out there. Richard Curtin, who's just retiring, started this survey in 1974, and it is recognized as the best in measuring consumer sentiment. Consumer sentiment is down to levels that we last saw at the depth of the coronavirus, both in November and December. Now, that's a very important part of the time of the year for the consumer to be feeling a little unconfident because it's the biggest selling season of the year. And so that, we believe, has become a problem. We have numbers for November. Retail sales were down they were up 0.3%, But when you take inflation out, what did real spending do? So what was unit growth in retail? It was down 0.3%. If you annualize that, that's about 3.5% at a really important time in the year. Retail sales are mostly goods. If you add in services, you see that real consumption in total, goods and services, was flat. Again, very important time of the year, and a time also when we thought this pent-up demand for services would cause a burst in service consumption. We didn't see it. So that is one indicator telling us something is not right out there. The other is, again, reflecting on third quarter GDP statistics. In the third quarter of last year, real GDP was up 2.3%. It was a big disappointment relative to expectations. But what the headlines did not feature, and still are not featuring, is that practically all of that growth went into inventories. It wasn't sold. Real final sales were up a tenth or maybe 0.2. So even in the third quarter, now remember, that's reaching back to June. Even in the third quarter, inventories were starting to build at a time when everyone was talking about supply chain problems. And I think what we were beginning to see is the consumer getting quite upset that necessities, the prices of necessities, were escalating and destroying purchasing power. So that's interesting. Now, what gets even more interesting is watching the inventory numbers in the fourth quarter. Wholesale inventories in October were up something like 2.5%, 2 to 2.5%. Now, that's month to month. That's not year over year. Annualize that, and we're talking about 25 to 35% increase in inventories. Remember, this is when supply chain issues were causing all kinds of shortages. And then again, in November, wholesale inventories up 1.2%. Again, double-digit rate annualized. Part of the reason is consumption was not playing ball. And then you look at retail inventories in November, up 2%. That's month to month. Annualized 24% plus. So this is something I don't think the headlines have captured. You might be surprised to hear it as well. Now, we have some other very interesting statistics. Imports in November were up 4.7%. Again, supply chains clearing up, the ships finally being cleared, not completely, but a lot faster. Did that go into inventories? They didn't make it into consumption, at least unless there was a barn burner of a December. And we do hear the credit card companies talking about strong sales, but they've been talking about strong sales for quite some time. The economic statistics, which are much broader based, are suggesting that that's some kind of overstatement or share shift, mix shift. Then we get to autos. I think this is the most fascinating part of what's going on in the economy right now. The Manheim Used Car Index has been screaming. I think the prices of used cars at their peak had increased on a year-over-year basis something like 60%. And that was adding to the CPI. Well, very interestingly, we've had a few reports now that suggest that the bubble was in used cars and that it might be bursting. We can see this a few ways. On a year-over-year basis now, used car sales units are falling. They're down 4%. November to December, they were flat, but year-over-year, that was down 4%. We're seeing prices finally start to fall. They were down 1.2% month to month. Again, that's a big decrease month to month. Annualized, roughly 12%. On a year-over-year basis, they're still up 46%, but they have started to fall. And what tells us that they will continue to fall, and mind you, they've had a disproportionate impact on the CPI. What tells us they will continue to fall is now an inventory buildup in the used car space. Normal inventories for used cars are, I believe, 43 days. Now they are at 54 days, so well above average. And I believe at their lows, they were in the 20-day supply range. Now, many people are looking at the hike in used car prices, and they've probably been thinking about selling that car and that extra car maybe that they bought to avoid mass transit during the coronavirus. If they see prices coming down, they probably will move a little more quickly. And then on the wholesale front, this Manheim index says that inventory levels typically are 23 days. Now they are 33 days. So that's interesting on the used car front. On the new car front, fascinating. At an annual rate here in the United States, new auto sales peaked in April at 18.25 million units. Now, when we got to October and the auto OEMs were talking on earnings reports, each one of them, including Elon Musk, was saying, okay, the chip shortage is beginning to alleviate. Now, they had been blaming the decline in sales because it started in April, and it was declined to 13 million units from 18 and a quarter. That 13 is an October number. Chips were the missing link. Okay, they're starting to be replenished. November, 12.86. December, we just got this number, 12.44. Meanwhile, you've got electric vehicle sales up nearly 100% at an annual rate. What's going on here? Well, it could be a combination of consumer sentiment not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show. And we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend on electric, then these OEMs have an issue. They have a problem. And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it. Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time. So very, very interesting there. And the other December statistics that we got, besides autos, are the PMIs, the total PMI and PMI for services. Both of them came down, and prices paid in the Purchasing Managers Index came down a lot more than people were expecting. It was, I think the expectation was somewhere around high 70s, 80. This is a diffusion index. Instead, it was 62. Now, that still means prices are up because they're still above 50, that diffusion index, but coming down, we think, pretty fast. Now, one other thing I'd like to focus on here is China. So much is going on in China that, again, the headlines are getting some of this, but within 1 week, a Bloomberg journalist, Sofia Horta Acosta, reported that all of this happened in Greater China this week. I'm going to just read you a few of these to give you a sense of the drama here. Evergrande suspends trading on the stock exchange. And the developer, Evergrande, was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States? The 100 largest developers in China reported that their contracted sales were down 35% in December. And for the year as a whole, they fell for the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. Hong Kong's instituted strict border controls, banning arrivals from US, UK, Australia. They are shutting down bars. They're shutting down evening dining. Let's see, a few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market. And the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start, but they haven't done anything about it yet. And very interestingly, the yuan, the RMB, the local currency, after a very strong year, held up. And I think it held up probably helped by the government, supported by the government. It is starting to weaken, quite a telltale sign. And one stock, Hurong, which had not traded since last March, opened this week and dropped 50%. Now, when China catches a cold, commodities usually catch pneumonia. And we're seeing this in a few commodities, iron ore prices and so forth, but it isn't quite clear cut yet. And I was saying to our team this morning, how could this be happening and the economy not be falling apart and the consumer not getting restless there? Well, the consumer savings is 75% in real estate. But what I learned this morning, and it does make sense, one of our analysts, our newest genomics analyst, Pierce, worked in his lab as he was getting his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. And he learned that a greeting in China, the equivalent of a hello, is basically, I hope you have enough to eat. And so pork prices and rice prices are critically important. And what do we see happening there? Pork prices are down, depending on the measure, 33 to 50%. Rice prices are fairly flat. And apparently that keeps the consumer happy. Now, I don't know. I think this property debacle is quite something, so we shall see. Before moving on, I'd like to just talk about the fourth quarter GDP. It will be strong. Now, not as strong as some people thought. It was going to be up 7%, and now I guess the Atlanta Fed said it'll be closer to 4.3%. What we're going to be watching is how much of that is in inventories, and I think quite a lot will be. Now on to market signals. And I realize I'm spending a lot of time, but I just want you to understand how we're pulling apart the data, and we're seeing things that others are either not seeing or for some reason just not reporting. The yield curve peaked at 130 it was February or March of last year. I think it was March, and has been falling. Now, the yield curve is the difference between short and long-term interest rates. Normally, long-term interest rates are higher than short-term interest rates. They were, as measured by the Treasury curve, so government bonds and notes, the yield curve, the longer-term bonds were 130 basis points, 1.3% higher than the two-year yields in March of last year. At the end of last year, that number was 80 basis points, 0.8%. Today, it's 0.6%, even though bond yields are up, short yields are up more in response to the employment report and that 0.6% on average hourly earnings. The yield curve narrowing generally is not a good thing for financial stocks, but this rotation into value stocks, energy is up 5% this year, financials up energy is up 10%, financials up 5%, and they were two of the strongest sectors last year. Seems to be on automatic pilot. This yield curve would suggest that financials should start to underperform. So we shall see. The rotation is still towards value. It is hurting growth. We think it's long in the tooth. We think it's going to end, but it hasn't ended yet. In the fixed income world, we're also seeing credit spreads. So we look at junk spreads. So how much higher are low quality companies' yields or interest rates than higher quality? And right now we're seeing no disturbances, very little. The fixed income market is buying into this rotation into cyclicals. They haven't been paying attention perhaps to inventories in the way we are. Commodity prices are quite mixed. Oil prices peaked in the early November timeframe, I believe it was, around $85, $86. They went all the way down to $62. So in the next couple of inflation reports, energy is going to be a negative. That's interesting. Iron ore prices are still down quite significantly from their peak, and that does corroborate with what's going on in China. But most are just meandering, most prices in trading ranges. The dollar is up, and that is causing all kinds of problems in the emerging markets. The Turkish lira, as I mentioned on our last video, the Turkish people have lost half of their purchasing power in 1 year relative to the dollar. That's the Turkish lira. Has gone from 7 to about 14. It was as high as 18, nearly 20. And I think it's going to go back there because their foreign exchange reserves were cut in half the last month to something like $6 billion. $6 billion is nothing to withstand the onslaught of the currency speculators. We're also seeing Kazakhstan, the protests there, shutting down the country's internet. I know Russian forces are in there. I think we're going to see a lot of more hotspots in emerging markets. And the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars. The dollar's going up. All other things equal, commodity prices would go down. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. And I'd like to end right now by talking through just one more thing, going back to autos and giving you a sense of where the bubble might be in this market. It is not in innovation stocks. They've been cut in half, many of them, some by 75%. But listen to this. I gave you the story about Ford reporting that it would have to double its electric vehicle production of the F-150 Lightning, and the stock just taking off, not paying any attention to the auto statistics I just mentioned. Well, when I think of what could happen in that space, and I see these stocks ramping on sales that mean nothing to these companies in terms of their earnings, shall we say, right now. In fact, they need to invest a lot more in electric to make it happen and to move the needle in these companies. But what if we're right and there is not a 20% increase in sales? Maybe sales are flattish year to year. That would put them at roughly 15 million units. And they'd probably have to start cutting prices if we're right on the used car market and the pricing there, which means they're probably going to be facing some credit issues since they're hugely leveraged to the credit that people take out on their autos. And as prices go down, residual values go down. And, auto credit was the best performing credit in 08-09. And so there's a lot of complacency in that market. In 08-09, the homeowner had to decide, okay, I can't pay everything. I'm out of work. What do I pay to just keep things going? Well, they were going to pay their auto loan down and default on their mortgage because it would take a while for them to get kicked out of their house, but they needed to get to their jobs. Today, that would change because of ride hailing. So we think that complacency is misplaced and that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected. And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks? Now that Zoom is down to 33 or 35 times this year's earnings? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along and the innovation that we see evolving so rapidly. DNA sequencing, transforming healthcare, robotics, solving the labor shortage problem we're having, energy storage, the consumer preference towards electric, artificial intelligence, which is the glue that is helping all of these technologies converge. And the last one, blockchain technology. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right and the economy has an inventory problem, then our growth rates are going to look far superior to anything you'd find in the value space. And we are really looking forward to that. So with that, I want to wish you a Happy New Year again. I want to thank all of the investors who have sent us words of support and have shown their support. Our asset retention has been pretty phenomenal. And I think it is because of the open source research ecosystem. We are sharing our research, and we've got this long-term investment time horizon. Keep your eye on that prize. And if we're right, the technologies around which we have focused our research, those technologies, we believe, will compound in terms of revenues and earnings for the companies involved. Is this going to happen in the next 3 months? I don't know. I can't tell you. Sometimes the market can remain irrational, and I'll say what's going on right now is irrational. Sometimes it can remain irrational. But I do think as we see these earnings reports coming in and the guidance for the first quarter and this fessing up out there into what's really going on with inventories, that we're going to see the turn sooner rather than later. And so we will be looking forward to that. And so once again, I thank you again for the words of support and belief in what we're doing. We know we're doing the right thing. And we're so happy to be with you on this journey. And believe me, the other side of what we've just been through is going to be delightful, in our opinion. So with that, I will say goodbye.